You know, it's interesting as well because now Fed officials say they're split on whether to pause or hike in June. You just saw the commentary there from Loretta Mester. Do you think the outcome of the debt ceiling negotiation also now influences the Fed's next move?
I think the Fed has got a lot of other things to worry about. Obviously, the fact that the debt ceiling issue will be a potential hindrance. Because when you look at it, even if they do agree to raise the debt ceiling, there's probably going to be a lot of issuance of treasuries coming into the marketplace, which will influence the long end on the yield curve, possibly causing the yield curves to steepen. But I think the Fed is mostly looking at the potential credit crunch that is coming. That's why I think if you look at the market consensus, it is likely that the Fed will now pause, because when we look at the data coming out from the US, at least on the bank loan perspective, it looks like there is a bit of a credit crunch that is going to happen over the next few months, which is effectively tightening for the Fed. So it means is that the Fed can actually stand pat for the time being. They still do their QT while credit basically is curtailed in the US, and then wait and see how the economic data materializes over the next couple of months.
You know, interesting as well, I saw in your latest update with regards to the markets that you're moving to an underweight equity position because of concerns around that liquidity crunch. Can you expand on that and the current thinking on how you're investing around this?
Well, I think if you look at it, there's a very strong correlation between credit growth, or at least liquidity, and risk assets. If you look at the year-to-date performance of equity markets, it's very interesting that in March we actually had a rally in like the tech stocks, for example. Most risk assets moved up in March with the SVB collapse, and incidentally, that was actually when liquidity was injected into the system. However, after that, we are starting to see liquidity come back out of the system again, which is why, equity markets have been kind of range trading over the last several weeks. But, with the credit crunch that we're talking about coming out, emanating from the US, potential QT continuing to happen, we are just a bit more cautious, because as liquidity comes out from the system, we think that there's going to be a risk-off move. And equities, especially in the US, are actually priced to perfection, because you look at it, valuations are pretty high. So we are a bit cautious in that regard, which is why we've moved to an underweight equity position.